Hi, this is Scott with Luminary Wealth. Welcome to Illuminate, video series where we demystify financial markets and dig into the science of investing based in evidence, not imagination. Let's do a brief recap from our last episode where we explored the benefits of a globally diversified portfolio. A well-diversified global portfolio can help capture the returns of markets around the world and deliver more reliable outcomes over time. We showed you the surprising results of 2020's first quarter, where China's stock market decline of 10.3% was one half of the U.S. market's decline of 21%. China finished the quarter as the second best performing country, barely edged out by Denmark, while the United States finished in 10th place. Something we wouldn't have expected based on the information we were hearing in the news or reading in expert forecasts in the midst of this coronavirus era. Take a moment to look with me at the slide we looked at last week. You'll remember this chart, and we were unable to tell, of the 23 countries on this checkerboard, which performed the best over the last 20 years. Now, looking at the U.S. that I highlighted here in green, we can see that's put up some strong numbers over the past several years, first in 2014 and third in 2018. Yet over the last 20-year period, the U.S. has had an annualized return of 4.9%. That puts it about in ninth place or towards the middle of the pack. Now let's take a look at the top performer highlighted in fuchsia. The highest developed market country return over the same 20-year period had an annualized return of 9.1%. And that country was Denmark. Now, looking at how Denmark achieved that top spot, we see it only had the top return one of the past 20 years, only to be followed the very next year where it came in last. This might not be what you would have expected to see for a top-performing country over this period. The random patterns of these returns show how difficult it is in trying to predict how any country might perform year to year, while a globally diversified strategy would have captured the performance of markets around the world, including both Denmark and the U.S., with less volatility than investing in any single country. Now, let's take a look at a globally diversified portfolio and compare its returns against a U.S.-only portfolio that is represented by the S&P 500. We'll take a look at the last 5 decades. The globally diversified equity portfolio will be comprised of 70% U.S. indexes and 30% non-U.S. indices. What you're looking at is a graph comparing the global equity portfolio in blue, the S&P 500 in orange, and 1-month T-bills in green for each decade beginning in 1970. Each chart will show how much $1 would have grown over the decade if it had been invested in each portfolio at the start of that period. So let's take a look at the 1970s. As you can see, in this decade, the global return beat the S&P 500 by about 2 times. Another highlight is that the S&P underperformed the 1-month Treasury bills for that decade. A bit of a surprise. Let's go to the next decade of the 80s. Here again we see the global portfolio beat the S&P 500, this time by about 1.5 times. Let's go ahead and move on to the next slide where we're showing the decade of the 90s. Here we have a reversal. On this slide, we can see the S&P 500 outperformed the global portfolio by about 1.5 times, almost a mirror of the prior decade. Now let's move on to the 2000s. This is an interesting decade as we see the S&P 500 underperformed the global by 3.44 times. What's more is the S&P ended up in the negative range for the decade, underperforming even the 1-month Treasury bill by 1.84%. not a stellar quarter for the U.S. Moving on to the 8 years beginning in 2010, now we have a reversal back again where the S&P beat the global market by about 1.2 times. So you can see over these past 5 decades, the global portfolio had the higher return for 3 out of 5 decades. Let's take a look now. If we combine them all together into one slide, what's the outcome? There you have it. Global portfolio versus the S&P 500 over that 48-year period of time shows that the global portfolio beat the S&P by about 3.6 times. So $1 would have grown into $4.22 in the global portfolio, while $1 in the S&P would have grown to $116. So I hope you can see that investors committed to a globally diversified strategy are in a better position to capture the performance of the global markets and deliver more reliable outcomes over time with less volatility than an individual country. I hope this can help you stay on track toward achieving your long-term goals. Until next time, stay safe and stay healthy.